Hello and welcome to the Monday Call, brought to you by NZ Funds. I'm James Grigor, and this week we're joined in the Auckland studio by NZ Funds CIO Mark Brooks.
Morning.
So, Mark, in our first podcast of this year, you outlined expectations for a positive but volatile year, with the US starting at high valuations and lofty expectations, while other markets faced a much lower hurdle, other markets being NZ, Europe, etc. Over the past month, we've seen a sharp shift in sentiment. Bearish sentiment has surged to 60%, a level that typically signals a peak in pessimism. So what we're going to cover today is what's driving this: tariffs, European fiscal shifts, and growing doubts about US exceptionalism as its share of global markets reaches 65%. And this doubled in the past decade. But the real risk, in our view, is missing out on the bull market as the bull market returns when stocks eventually resume rising. Beyond equities, we'll dive into China and copper, the US dollar, gold, Bitcoin, and before closing, we'll finish with New Zealand, where economic data is showing early signs of a turn. The agriculture sector remains strong, and local shares may be bottoming out. So quite a lot to cover in 45 minutes.
I was going to say, yeah, there's an awful lot there.
So we'll get the crystal balls out and should we get into it? So I guess, Mark, perhaps kick off with setting the scene about what's happened and where we're at, and then perhaps we can talk about some of the catalysts, and then we'll go from there.
Yeah, I think useful to, as you sort of said in the intro, go back to what we said about sort of 6 weeks ago at the first podcast of the year, was that, if we think about especially the US market, that's been on a bit of a motorway ride over the last couple of years, 2 years of 20% plus. No real major setbacks along that way. So, a pretty smooth ride. Did feel and, sort of talked about, I think, that, the framework which we want to sort of think about is where is the macro or the economic setup? And, US again has come from a period where growth has been strong, and a lot pointed to that growth remaining pretty strong. The Fed had cut rates, but had started to signal that they were going to back off on the rate cut process, generally because the economy was looking pretty strong. Unemployment wasn't up a lot. So from that point of view, that set the framework, or set the starting point for a pretty strong outlook in terms of sort of growth going forward, despite things like tariffs, etc. At the same time, valuations, because of 2 years of 20 plus returns, are up an awful lot and are not cheap. And likewise, in that environment of sort of US exceptionalism, expectations were pretty elevated. People were fully invested in shares. And, we've spoken a number of times over the last couple of years about where were expectations at the start of the year, and sort of pointed out that last year, at the start of the year, the expectation for the US share market on the part of strategists and bank economists, etc., was for a plus 2% year in the share market. We ended up with plus 20. This year, the expectation was for plus 10 to 12. That was from levels quite a bit higher than where we are today. So, there was embedded, had a lot of positivity embedded in that. And, that's not to say that view is wrong even today. You've got a lot of positives about where the US, if you think, and we'll sort of touch on tariffs, etc., but if you think of sort of what does the US have going for it, AI clearly is probably front and center, and that's something that in the last little bit people have sort of started to discount. And then you've got deregulation in terms of a Republican government and potentially tax cuts. So there's a lot there that's quite positive. But one of the other things, if we look back through time, we sort of said, well, valuations are a very good guide in terms of long-term market outcomes. If valuations are high, it does tend to suggest that like a 10-year forward return is going to be lower, because valuations matter over that sort of time frame. However, if we come back to much shorter time frames, valuations don't matter as much as long as the expectations are being met. And I think that's the point that we're seeing at the moment, is you've got a confluence, especially in the US, between high expectations and high valuations, and really due to things like tariffs and probably also Doge and sort of US government spending or reduced government spending, there is, people are turning the volume down on the expectations for what the US can do going forward, and given you've had that sort of, compare or high valuations and high expectations, sort of 1 + 1 ends up making 3. So if you end up taking one of those away, you actually come back fairly sharply. So
I guess one way to look at it then is what you're saying is it could be any piece of news that's the catalyst for market volatility when valuations are at levels that we're seeing them. And so this one is quite pronounced in terms of everybody's
speed, and it's
and just the ramifications around things outside financial markets, being at wars in Ukraine, angst between the US's biggest friends being Canada.
Yeah.
But actually, if it wasn't this, if it was a totally different government that were in charge in the US, we might be seeing this anyway. It might be a different catalyst, but when valuations are high, we tend to have some sort of correction. But at the same time, valuations are high, economy's strong, earnings drive higher, and actually that the biggest risk, and what we said in the intro, is fear of missing out, because stocks in the end will charge higher.
Yeah, and I think, as I sort of said, on my framework for thinking about this year is very much saying, well, where is that macroeconomic base? That is not the only factor we consider. Then it's about thinking about valuations and expectations. And what we sort of outlined in the first podcast was, well, actually, we still think the US has an opportunity to have a positive year for all the reasons just discussed, but the hurdle's really high, and that makes it more challenging. Whereas if we look at, if we looked at other markets, hurdles seemed much lower because valuations and expectations were much lower. And really, probably I suppose the three markets that stood out there were Europe, China, and New Zealand ultimately. And people weren't necessarily building in, especially in the case of Europe, much positivity. As it's turned out, that flow started towards Europe and really has been catalyzed by the fiscal announcements in Germany, which are a really big deal, I think. And perversely, you probably wouldn't have got that under a different US administration. But for those who haven't caught up, Germany have announced, and it'll go to a vote this week. It's pretty close. What's probably expected to go through, that they're going to have a 500 billion euro infrastructure fund over 10 years. Now, that's about 11.5% of GDP, which is, over 10 years, about sort of 1.1% of GDP per annum. A decent number, but maybe not it doesn't sound that big, but you put it against your German growth, which has been anemic really for 20 years, pretty much since unification finished. And, their growth, including inflation, has been about 2 to 2.5% per annum. So essentially you're adding a whole nother percent to that. So all of a sudden you're going to be sort of 3.1, 3.6. And then on top of that, you've got these announcements about their defence spending and excluding that from their budget constraints. So, really taking it from sort of 1 or 2% to sort of, 2 to 3 or maybe more. So, that's a material change for a major region of the world, which just has not had that sort of fiscal stimulus. And, again, may sound overly simplistic, but, we think about where does spending come from, and it's either consumer or it's government, and you have, the main European government for the first time in really 20 years spending properly. So, we'd see that as being really positive. And again, that's really helped catalyze the European market. It's one of the best performing markets this year. I think it's up close to 10% year to date. And that's really the one, investment in that market was low. 2, expectations were low and valuations were low. So, you've seen really what you've seen a lot of is not so much about people, maybe in the last week or so, people taking off risk. It's more about risk changing and people saying, well, actually, and you touched on it in your in the intro, is that I suppose what's happened with technology primarily is that it's kept dragging money into the US over the last 10 years. And we've got to a point where, in terms of the global share market indices, the US is now 65% of the world and almost double, ultimately where it was 10 years ago. And maybe we're starting to see the first signs of that starting to normalize.
And we'll talk about this later in the episode, but that's what was that thematic you talked about in Europe is the same as we're seeing in New Zealand as well, with expectations and actually some green shoots. But we'll touch on that later because it's super interesting, some of the data coming out in New Zealand to, I guess, as a little bit of a canary in the coal mine around growth.
And that point about expectations, remind me to talk about sort of the different. It's just one day, but I think it's useful as the earnings result for Fletcher's, which was ugly, versus the earnings result for Nvidia. We'll come back to those. Yeah, some interesting market reactions.
I think it would be amiss if we didn't touch on tariffs just for a couple of minutes because it is the catalyst, and it is what is causing, I guess, a lot of the volatility. And there's some offshoots to that, Doge, etc. Like you said. Do you want to give a brief overview on why the market is concerned around tariffs and perhaps why we're slightly less concerned about the effects they'll have on the economy?
Yep. Excuse me. In terms of, look, I think there's two ways to talk about tariffs. One is markets are very much about they price what is here today and they price what is expected. Now, clearly, tariffs have been in the news for a substantial period of time. So it's definitely in the price to some degree because it's not new news. And it's interesting that Trump seems to have taken the approach that it's almost sort of this forward guidance type idea is, the tariffs are coming, and then he uses a negotiating tactic. And whether we get them or not it is unknown, but you get that point. I think generally the path over the last couple of months is the market calibrating that a much higher degree of tariffs are likely to be are ultimately to come out. So I suppose if you go back to the Trump 1.0, the tariffs were really only against China, a few other specific sectors, but really only against China. And at a point where, because it was China, there were of probably relatively narrow import lines, a lot of that was borne by China. Didn't actually impact the American consumer a lot. What he's now talking, and especially things like Mexico and Canada, is a much broader set of tariffs. And I think the market generally has brought in the assumption that actually tariffs will be a much higher rate than they'd previously assumed. And being higher and wider, there's this talk of the reciprocal tariff. So basically saying if we'll put a tariff if we perceive that you are charging a tax on US goods. And also had this comment, which seems pretty odd, but considering something like a GST or a VAT, a tariff, which seems rather odd given it's charged over everything, be it domestic or international, but that's for another
day. Don't get in the way of a good story.
Yeah, exactly. But essentially the market's saying, well, actually we think tariffs in general will be across the board higher. It also means, unlike the China ones, that actually they're probably going to impact the US consumer more because, a good example might be China and Mexico and the car industry. There are some suggestions that each piece of metal or each car effectively goes across the border 4 or 5 times prior to that car being finished, at which point it would attract a tariff
every time.
So really the market is saying, oops, we've got to bring that in. And I think an interesting point would be somebody like, we deal a lot with Goldman Sachs, and for a number of years they've been quite, I suppose, above consensus or above sort of average expectation for US growth, and they started the year at 2.4, 2.5.
In GDP growth.
In terms of real GDP. So that's before inflation. So, ultimately you're talking sort of a 5.5% growth rate. So pretty robust growth. They've taken that down from 2.4 to 1.7. So a pretty meaningful decline. Still not recession, still growing. But really just that reflection that tariffs are going to take quite a bit of growth off the top. The other one that's interesting, and I think the market is getting its head around, is, again, last time it was those tariffs being just on China were borne by China. We didn't really filter through to the US. Their expectation now is because of essentially probably the risk of the breadth of those tariffs is that, you probably see inflation, which ended the year in the US at sort of 2.6%, which was actually probably naturally on a path down to sort of 2%, is probably more likely to end the year closer to 3%. So it sort of creates that tension, I suppose, ultimately. So, that's a long way of saying, look, I don't think this is not new news for the market. It's just recalibrating how it needs to feed that through.
What I think is interesting about the tariffs is a lot of people are asking, as I sort of travel through New Zealand on the road, talking to our clients and business partners, is why are they doing this? And I think that twofold to that question, and I think it's super interesting. Is one is, well, it's recalibrating the global norms around trade, etc. But it's America first type policy. But the two I wanted to touch on is one, it actually allows cuts in personal tax rates to be funded. And what's more popular in the US than anything else is tax cuts. But with the amount of debt and the size of the budget deficit, they can't really do it without getting in other income. And that's one way of doing it. Now it's taxing the same people because it's the consumer that's going to get the tax cuts and it's the consumer paying the tariffs, but it still has the perception that it's positive. But then the other one is, it actually is more revenue to pay down and reduce the deficit, which I remember traveling around New Zealand years ago, and the question I'd always get at a pretty sort of a big presentation was, you're so positive on the US, but what are they going to do about the debt? Well, this is one way that you can start reducing that debt and reducing the deficit to reduce the debt.
Yeah, well, it is fair to say that, the balance sheet of America Inc., all of America, is really robust. Debt levels across the entire economy, including the government, are not a problem. But, you compare and contrast to New Zealand. New Zealand's debt levels, government debt levels, really are not very large. There's a lot of discussion in the media about that, but ultimately they're not very large, and the debt service components are pretty small. But one thing that is different is the New Zealand government is a much bigger component of our economy relative to GDP. The US is kind of the reverse. They're actually, you have a $30 trillion economy, and their revenue, or sort of tax take and other things, is about $5 trillion. So, that's a relatively small.
What would that be in New Zealand?
Off the top of my head, from memory, the total revenue number is about 150 billion on a $420 billion economy.
So it's a quarter of the economy, whereas in the US
it's about 15% sort of thing. So you've got a very different size. Whereas, the US, and again, this becomes maybe the challenge. US government debt relative to the size of their GDP is high at sort of broadly 1 times GDP, 100% of GDP, but debt relative to their income, which is a smaller part of GDP, is an issue. $5 trillion of gross income before any expenses, they spend about $7 trillion at the moment, and it's a $2 trillion deficit, which is clearly where the Musk Doge discussion comes in. But because they've got 30 trillion of debt, give or take, you are looking at about $1 trillion of interest bills a year, even at their sort of 3.3%. So from that point, that becomes they've essentially doubled debt over the last 10 years in the US government. So there is that issue of, and I suppose again, maybe that's something else that's also coming into that sort of US exceptionalism discussion as well. One, valuations are high, everybody owns this market, and if we think about sort of spending going forward, maybe the government is going to be less. It's been fueled a lot by government fiscal spending in the US. Maybe the consumer and the government are pulling back a bit. So,
and you know what? Let's let the Europeans spend some of the defence spending rather than us, because why should we be spending it when our debt is getting a little larger than we perhaps would like it to be?
Yeah. So I think it's probably having kind of sort of and I suppose in a way talked about in the first podcast. Ultimately, I think a lot of the expectation was very one way coming into the year, that US exceptionalism was going to continue. Now there's some more two-way discussion about, well, there's a few buts out there, and that's why pricing has come back. But I think the other one and that I think is important to remember is, and we get sort of the odd question from clients, is sort of say, well, is this the start of something larger? And we'd always sort of caution that when you get really sharp moves, and the US is back sort of, and it's also worth remembering, we had a very strong run in US shares post the election, had a good start to the year. But, and the S&P had a peak on, I think, the 15th of February. So, almost exactly a month ago. And shares are down. I think the S&P did its worst, was 10% off that peak last week. It's now sort of 8 and change. Had a bit of a rally into the end of the week. So when you have sort of sharp sentiment-driven changes like that, often they tend to be relatively short-lived. If you get a more meaningful downturn, they can often start, those tend to start more slowly.
Yeah, it's the bear market grind versus the correction. And in fact, it's why people like us, when there's a correction like this, the always talk about the best thing to do is do nothing, stay invested. And if anything, when you look at those long-term share market charts and think, goodness, that would have been a good time to enter the market. Those are the times like now that feel really uncomfortable, but actually are the best time to enter. And these corrections are really opportunistic to go, in fact, we haven't seen an opportunity like this to buy these companies this cheap for quite some time. And if you're really worried, if the market is really worried about long-term degradation of earnings and share market returns, it doesn't happen like this. Actually, it's a long, slow, death by 1,000 cuts type of market, rather than a correction where opportunistically this is the time to look at your favorite stocks and start buying them back, because you're getting them way cheaper than they were.
Yeah, look, I know it's probably for some clients it's sort of easy for us to say, because we live and breathe this every day, and ultimately have been through many of these sorts of swings. So for some clients, especially those who are new to investing, it can be pretty unsettling. But it is that point that to many degrees things are on sale, and it's kind of the framework. How do you approach it? Do you say, well, I'm getting worried because prices are lower, or do I actually say, well, prices are lower, so that is a positive? And I think one of the examples is somebody like NVIDIA, the poster child for AI. Because sort of in the wake of DeepSeek and the Chinese AI and things like that, you've seen generally technology, and it's probably worth saying that a lot of this move lower in US shares has been very much technology driven. A lot of the value or sort of more traditional industries have actually done maybe not well, but they've held their own, whereas it's really technology, US technology, that's pulled back the hardest. But something like NVIDIA, it's up a bit now, but at midway last week was at one point 30% lower than its peak. This is a business that, if we think, and we talk a lot in multiples, so how many times earnings are you having to pay for it? That business, probably, well, it did peak at sort of, if we think in EBIT, so earnings before interest and tax, sort of peaked in 22. I think it's sort of 40 times. More recently, it's been around about sort of 25 times earnings. For a business that's growing so fast and makes a 71% margin on the things it sells, that makes sense. Maybe a little high, but it certainly makes sense. Given the 30% decline, looking at forward earnings, that business at one point last week was trading on 16, 17 times, which actually is the cheapest it's been since 2006.
It's trading like a utility.
Yeah. It's
got a 70% margin and growing it.
25, 30, 40%, 50% per annum. That's as cheap as it's been since sometime sort of 2017, 2018. So it is that proverbial sort of, are you throwing the baby out with the bathwater a bit?
I'm also looking down at your notes, Mark, and I think it's also important to remember the bond funds. New Zealand bonds up, almost 0.5% this year to date. Global bonds up almost 1%. I mean, the portfolios, you did touch on it. It's a really good point that some of the our either newer clients or ones that are perhaps, don't appreciate, or no one appreciates, but can't afford the volatility as much as others. Well, if you have that asset allocation correctly managed through advice, the bond portfolios are not just stable, they're grinding up because people in corrections like this do put a bit more towards those defensive assets, meaning they trade up.
Yeah, exactly. And I think we do create a little bit of a rod for our own back in the likes of these discussions. We often become very share-centric and often very US-centric, but actually, ultimately, the portfolios are very diversified. And even if we think about sort of the volatile end of the portfolios, and specifically sort of say something like KiwiSaver Growth, which tends to be sort of the flagship product, which is predominantly shares, that is positive this year. It's come back. It had a very good start. It's come back a bit since then, down a little less than sort of 2% this month, but it's still positive this year. It hasn't seen sort of those large declines you've seen in the US. And it's also highly diversified. You own the US, clearly, because it's a big part of the world, but you also own Europe, UK, China, New Zealand, Australia. You own bonds in there, effectively. You own different assets. You own a bit of gold, and things like that.
The other thing I wanted to touch on around diversification and thinking about other markets is, maybe it's because I've been in the UK for the last 2 years, but there's this obsession with Russia, and quite rightly from a geography point of view, and the war in Ukraine is very, very destabilizing, and it is causing a lot of increase in defense spending in Europe. But Russia's economy is smaller than Italy, and it's not often we talk about Italy as the global driver of share markets.
Well, European economy is 10 times larger than Russia, to put it in context.
Exactly, and so, but it's relevant from a war footing point of view, irrelevant in some ways from a market's point of view. But one market is certainly not irrelevant, and we touched on it in the last podcast when we talked about the geopolitical aspects of it, but China, and it's it's second biggest economy in the world. The share market is enormous, and it's gone through some real issues over the past couple of years around housing and debt levels, etc. A reducing population. I think the population of China reduced by 10 million last year, which is unthought of, considering the one-child policy to reduce population growth just a mere sort of 10 years ago. What is our views around China and our holdings and how we think about it, and is it something that that we want to participate in?
And yes, definitely.
I'll happily talk about it. I'll let
you. Yeah, well, you can definitely give us that view from sort of the European perspective, and it's really important from that part of the world. But I think, again, coming back to those simple things, think about what has happened in China over the last 5, 6, 7 years is really, what they've wanted to do is I suppose, go along that path a bit like Japan did. Yeah, they have been through a phase over the last generation of building China up basically through becoming an export powerhouse. They need to transition that into more of a domestic consumption economy, less export focused.
But the population just keeps saving.
Correct.
Amazing savers.
Exactly. And that's one of the really interesting things going forward is if that gets unleashed at some point, there is a massive amount of capital to be put to work. So you've got that intent and, at the same time, so essentially, what the government wanted to do was build out a number of the natural consumer safeguards you get here, things like Consumer Guarantees Act, all those sorts of things, partially which was some of that sort of data crackdown stuff and tech crackdown that happened a number of years ago was really around that. But more broadly about sort of encouraging domestic consumption and also domestic investment. And the confluence there was that, most, a bit like New Zealanders, most Chinese, their first port of call for investment was housing. And that was really important when there was, we're coming out of almost a peasant economy, but the government wanted to migrate that and make that less important and felt that it was a highly levered and systemic problem. Yeah, they did put pressure on that and ultimately were a bit too successful, right? So, that market has really sort of dragged down activity and has been, it's their own version of the GFC, but, they have materially looked to stimulate and create incentives to, restart the housing market, but also to encourage the share market there. And if we look at valuations, Chinese shares have been frankly awful performance over the last 10 years. If you're in China and Chinese shares, that was you end up having a very different experience to being elsewhere. But at this point, if we look at valuations are super cheap. And likewise, expectations have been very, very low. And that's one reason why sort of the DeepSeek AI announcement created quite a bit of excitement. It's kind of reminded people that there's a tech sector there, and actually US tech's not the only investment and option.
Yeah, two comments from me on China. One is there's some disappointment about the stimulus the government put into the economy last year. But when you dig deeper into that announcement, actually they put the maximum they could that was signed off by the Politburo at the start of 2024. So they had X amount of dollars or yuan left to pump into the economy, and they put that maximum amount that they had sign off for into the economy. 2025 is a new year, and the expectations are that budget and therefore the stimulus to go into the economy will be much, much larger. And that creates, I guess, a lot of catalyst for the economy to start resetting. The other interesting part is, I don't have the numbers off the top of my head, but it's something like the size of Manhattan in China of unfinished housing. And that's because a lot of the developers borrowed money and have run out of money. And a lot of that stimulus is going to be put into that sector to maybe not restart and new housing developments. Sorry, not start new housing developments, but restart the unfinished Manhattan Island equivalent of unfinished housing in China. And very, very stimulatory, obviously, one. But two, has some idiosyncrasies which we're also excited about, and hence positioning in the portfolio. And one of those is copper. If you think about if ever had the privilege or not of doing a renovation or a house build, the wiring goes in relatively late in the piece. So you're doing the foundations, then the framing, and then you start doing things like wiring, and that's really where the copper starts becoming consumed within the house build. And if you times that by the number of houses there are in Manhattan unfinished, that is a lot of demand for copper. And at the same time, if we think about, and I'm sure you've talked about it here before around the thematics around copper and the fact that there is just a massive undersupply of copper globally, and at the same time, if you want more supply of copper, it probably from start to finish takes 8 to 10 years to get a copper mine up and running.
If you're lucky.
If you're lucky, if you don't have issues around absolutely legitimate issues, but around ESG, but also they're often in places which have corruption, volatile
unstable
markets.
Governments. Yeah.
And so the demand for copper, and that's just in China housing, not to mention lots of other places where the market increases in generating electricity because of AI and computer power means, what are the big infrastructure assets that need copper is data centers.
Exactly. Actually, one interesting comment I heard the other day, which again, you kind of, often it's that sort of point of going a little bit deeper. Somewhere like Germany, which has had this massive project and has really been a world leader in green energy and building green energy over the last decade. None of that has been incremental addition. It's all been replacement of replacing existing dirty power stations. They're going through a similar situation to the US, where actually after many years of flat electricity consumption, I think consumption now is about the same as when about the time the wall came down, so been very flat. They're actually, through things like data centers, etc., expecting about 2% per annum growth in electricity. Doesn't sound a lot, but that's a really big number. So from that point of view, that's, how do you create electricity? You need copper. So, all of our thinking about any commodity, be it gold, be it Bitcoin, be it copper, it's always about how is that demand-supply tension being managed. And clearly in copper, it's one that has been promising for a long time, but you sort of further through time you go, you feel that tension's becoming larger and larger.
So when I summarise that before we touch on New Zealand and a couple of other asset classes, if we think about our global equities, there's effectively three regions globally. When we think about from a portfolio perspective, there's US, there's China, and there's Europe, sort of Europe, UK. And I think it's fair to say over the past 5 years, there's been very, very US-centric.
Yeah.
And now we're sort of moderating that to be more globally focused, and so in a sense, profit-taking from the US and making sure we have exposures in places like China and places like Europe and the UK to broaden the geography of returns that we think we can generate within markets. It's not about reducing share exposure because, as we said at the start, we're actually really excited about some of these markets.
Yeah, and I think the one we used on the first podcast was really that actually we think it could be a good year, but we don't expect US to lead this year. It could be other markets. So we do want that sort of, we always have that breadth and diversity, but probably just more focus on it this time.
So we promised we'd talk about US dollar, gold and Bitcoin before jumping into New Zealand. So I guess US dollar, gold and Bitcoin are kind of all the same sort of drivers in some senses, aren't they?
Yeah, a little bit. I'll come back to dollar, but I think gold and Bitcoin, it's demand and supply. Bitcoin especially, massive demand increase post the Trump election. Lots of good reasons for that. You have an administration which is likely to be much more positive, or is much more positive towards crypto. I think it is that sort of issue where expectation got well ahead of itself. That's in the process of normalizing or unwinding a bit at the moment. Still think there is positive path ahead for that, but for us, that's an asset we have had a position in for a long time. We don't have to have a position in terms of portfolios. We've had periods over the last sort of, this year, where we've had no positions. And in terms of here and now, we've got a small Bitcoin position, but you definitely see that it's a point where you've seen demand got ahead of itself relative to supply. Gold is interesting. I think you continue to have, on the back of sort of the Ukraine-Russia war, generally central bank buying continues. It takes up a third of all gold supply. The one that we're watching quite closely at the moment is really that investment demand. ETF, which a lot of people get their gold exposure through exchange traded funds, ETFs. They really probably since early 2000s have been on a declining path, and that recently has turned, and people are sort of looking more towards gold as an investment option. So that sort of creates a new form of demand.
And unlike in the 80s when gold companies took in investor money and then didn't buy the gold, the ETF, every dollar of gold they get into the ETF, they have to go and buy a dollar of gold,
exactly,
in physical gold in the market. And so despite you buying, synthetic in terms of ETFs, you're actually buying physical gold.
You get a direct exposure.
And perhaps why you're seeing, apparently, if you look out the window of a flight that if you're lucky enough to be landing in New York, as the bags come off the airplane, you're also seeing some cases of gold come off as they ship that gold to storage units across the world. So don't know if it's rumor, but it's a great story to show that the demand of physical gold is really what's driving this. It's not just markets. We've got 5 minutes, and it's a good time to touch on New Zealand and positivity around the signs of economic growth.
Yeah, well, I think it's the yin and yang, right? Because ultimately the most challenging market for us, and if we look across the portfolios, the portfolio for us that's underperforming the most is New Zealand and Australian shares. And that's disappointing, but actually it's probably the portfolio which is the most exciting at the moment, because we saw a earnings results in February for the last half of last year, which were frankly ugly. Pretty much everybody, even a business as economically insensitive as Chorus, did say they saw people trading down or not trading up to higher speed products. So did see an impact of that. So very clearly the economy had a very, very hard back end of last year. But I think if we think through the different areas, you touched on it briefly on the intro. We've the agricultural sector, which we don't get exposure to really in the share market, is doing really well. Maybe forestry is challenged, but pretty much every other sector is very strong. And with a currency, low New Zealand dollar down here, certainly against the US, maybe not so much against the others, but against the US, that makes it pretty attractive for the agricultural sector. So that's an interesting anecdote, which probably I'm sure a few people out there will probably agree with. Sort of talking to somebody in Christchurch recently, and they said, well, they'd always been told by a sort of older colleague that New Zealand recovery is always starting in Invercargill. And actually the South Island, the deep south at the moment, is the most positive, and you're seeing the strongest sort of growth in retail sales. So you're seeing those early signs. You've seen some of the economics in terms of the PMIs and the PSIs, the forward-looking business surveys are poking their head back into positive territory. And clearly we've had some really meaningful interest rate cuts. So, the New Zealand share market is pretty challenged, partially because of things maybe like Ryman with doing a large capital raise, but you're still very much, a lot of those names are really on sale relative to where they've been any time over the last 5 or 10 years. The other point would be that, one, if we look about, we talk about shares generating a long-term return of sort of 7 to 10% per annum. They go through periods where, different markets will underperform, different markets will outperform. In the 2010s, New Zealand massively outperformed, doing 15% per annum. At the moment, the 5-year IRR for New Zealand is probably sub 2% per annum. So it's been a really challenged period, and we know that there is an opportunity for those stocks to come back. So look, I think it's been tough. Do think we're near the bottom, and we do think that a lot of New Zealand shares are actually got a pretty good road ahead. The one other point which I promised to talk about is, again, that idea of expectation. And the compare and contrast would be that, something like NVIDIA. NVIDIA came out with its most recent earnings result, 33 billion, these sort of round numbers, 33 billion of revenue for the quarter. It's a monster number. They make a 71% and change margin on that. So they basically keep more than 2/3 of that 71 billion, that 33 billion every quarter. Their expectation for next quarter with the new chips starting to roll out was a $42 billion number. So massive numbers, in line and slightly behind expectations that people had, so pretty lofty expectations. So that share price was down 8% that day. Compare and contrast with Fletcher Building, a business which has been really challenged, announced, I think, a loss of $130 million, really ugly number, but it wasn't more ugly than people expected. As a result, that price was up about 6% that day. So, yeah, it's sort of really just, I suppose, trying to show why we talk a lot about expectations. Where is that sort of mix between valuation and expectation?
And with New Zealand, as people recognise the value that you can get by buying New Zealand shares at the moment, given the size of the market, those NVIDIA numbers you've just described just probably describe 2 times the entire New Zealand share market in revenue. I don't know, but it's something like that probably.
Yeah.
And therefore, as rotation happens back into New Zealand, as that value is, I guess, recognised, because of the lower liquidity of that New Zealand market, those share prices can move really fast.
Yeah, exactly.
And it's why, instead of thinking about what can we do to our New Zealand portfolio, because it's trading down, actually, this is the time to start thinking about, or we have been buying into that market, because it is getting cheap, and those markets can move fast.
Almost by definition, we will be early. That's when you get tough months like sort of February, it's a bit painful and etc. But look, I think we want to have positions and we want that portfolio to position for recovery, because we do think it is going to happen this year. It may take a full amount of the year, but again, markets will start to build that in along the way.
So I think that takes us to our 45 minutes. I think the way to conclude some of your remarks, Mark, is if this was a bear market, we would be thinking about total exposure to share markets. This is a correction. This is providing great opportunity to be investing in assets that we really like for cheaper prices. There's the stable part of the portfolio in the bonds, and some other alternative assets that are doing well, despite the share market valuations. Actually, things look pretty good, and as you said, it's hard to feel this when markets gyrating like this. But now's the time to invest. If you have money sitting on the sideline that's now getting much lower rates in term deposits, that feels uncomfortable, but the time to invest is now, and that's talking to your advisor around how you can make that happen, because this is the best time to really generate that great start to a long-term investment portfolio.
Yeah, and that's the key reason why we always want clients to work with an advisor, because it is about sort of having that longer-term plan and saying, well, where am I getting to? And will an event like this that we've seen, sort of market volatility that we're seeing, does that impact where I expect to get to over 5, 10, 15, 20 years? And ultimately, I suppose also the reminder that actually those plans that have been put together and those sort of return assumptions incorporate events like this, because they are, sadly, a natural part of investment markets.
Great. Thanks, Mark. Thanks, everyone, for listening in, and look forward to speaking to you again, Mark, in about a month.
Cool. Thanks all.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.